An S corporation is a good business entity type to use. I actually have it for one of my small businesses. But sometimes you want to use a sole proprietor or an LLC that files on their Schedule C. And I actually have businesses that file on a Schedule C. So it's not always clear which business entity type is right in all situations. So in this video, I want to talk about 8 tips before you settle on an S corporation. What's going on, guys? Welcome back to the channel. Or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle, and let's jump right in. So tip number 1 is looking at your particular situation, your particular set of facts. And I can't stress that enough. That is why I put it as number 1 on this list, because what works for you might not work for somebody else. So with the S corporation, if you hear that you can save a bunch of money on taxes with the S corporation, that is true, but not in all situations. In fact, in some situations, you might end up paying certain taxes, which could work out to more taxes with an S corporation than without. So you have to really look closely at your particular situation, and you're probably going to pull a lot of that from the other tips that I'm going to talk about. So tip number 2 are looking at the costs. So 2 costs in particular that I want to point out. The first one is your payroll costs. So in order to pay yourself with an S corporation, to pay yourself a fair wage, which is what you have to do by law, you're going to want to have a payroll provider. But you don't want to do this yourself because it's likely you're going to make a mistake at some point, and really you don't want to deal with that at all. You want to outsource this. You want to have a payroll provider help you pay yourself, even if it's just for yourself. You really want to look closely at this. Please don't try and do this yourself, but you need to consider those additional costs in having a payroll provider. Another cost that you're going to want to take a look at or consider is the filing cost, because a Schedule C is on your personal return. You have to file an 1120S with your S corporation, which happens a month before you do your personal return, which could just mean more filing costs. So take a little bit closer look to see if the costs outweigh the benefits or the benefits outweigh the cost to figure out what you want to do, an S corporation or a Schedule C filer. The next point I want to talk about is your W-2 or your day job if you have one. Now, if you have, or if you're a high income earner, it's possible that you can be a high income earner and it makes sense not to use an S corporation because of the self-employment taxes. So on the employer side, which you're not seeing at your day job with your W-2, your employer's paying those costs. But if you pay yourself as a W-2 employee, the same as you do with your day job, you're going to pay the employer side of it. But you don't get that back even if you go over the threshold, whereas a Schedule C filer could recoup the employer side. So really important to take a little bit closer look. Now this also works for the next point, which is if you have 2 S corporations, it's the same exact thing. So if you end up paying yourself too much or over the Social Security maximum combined, you're not going to get the employer side back. So take a little bit closer look. The 5th point that I want to talk about are state taxes on the corporations. So not every state is set up exactly the same, and not every state has income tax, but I do want to point this out. Tennessee has an excise tax only on S corporations or corporations. They do not have it if you're a Schedule C filer, and I think that's the same for New York City. And I don't know about other states in the country whether or not they have them, but you want to look a little bit closer because you could be paying additional taxes just because you chose an S corporation versus another entity type. The next tip I want to talk about is tip number 6, and that is going to be real estate. So there is a ton of stuff that we could talk about on real estate, but S corporations and real estate don't really mix too well in most situations. So you want to take a little bit closer look at this, especially with transactions where you're not even selling the property, but let's say you're taking the money or you're taking the property out of the business, out of the S corporation. That could be counted as a sale and trigger a taxable event. So you want to take a little bit closer look if you're using an S corporation when it comes to real estate. Tip number 7 is reducing your Social Security benefits. So if you're reducing your Social Security payments, your self-employment taxes, then you're also robbing yourself of Social Security on down the road. Now, maybe this is something that you want to do. You don't think Social Security is going to be there, or you think that you can get a higher return with those dollars, so you're just trying to put more money back in your pocket today, and that might be okay in your particular situation. But it's important to understand that for each dollar that you take away from your wages from self-employment and put it over to the distributions, then you're reducing the amount that's going to go towards Social Security on down the road. And the last tip that I want to talk about is the qualified business income, or Section 199A deduction. Now, for each dollar more that you pay yourself, even this is on the S corporation side, from the W-2 side, that's $1 less on distributions, and it's reducing the amount of your qualified business income. Now, all of your net profit on your Schedule C goes towards the qualified business income, which could be a very good deduction of 20% on the taxes or on the money that you're earning from that business. So you do want to take a little bit closer look to see if it makes sense, because again, not in every situation this is going to make sense. Now, I like S corporations for a lot of situations in a lot of different scenarios, but not in every single one. So you have to look at all of the facts. So if somebody asks me, I want to reduce taxes, I am thinking about an S corporation. But if we find out that they're a high income earner, or they have other businesses, or there's just a ton of things that you can go through with the S corporation and figuring out which entity is right for you, just take a little bit closer look. That was tip number 1, and it carries all the way through to tip number 8. And if you have any questions, let me know in the comments down below. And I'll probably end up doing videos on each one of these just to go through the math, to give you a little bit more detail on exactly how to figure this math out so you can make a more informed decision. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.